Let's look at the raw 2026 industry data. If you are a healthy 35-year-old needing a $500,000 death benefit to protect your family, you essentially have two options. Option A is a 30-year term policy for $28 a month. Option B is a whole life policy for $400 a month. That is 14 times more expensive for the exact same amount of protection if you get hit by a bus tomorrow. Over the next 3 decades, choosing that second option doesn't just strain your monthly budget, it mathematically creates a staggering $900,000 gap in your ultimate net worth. It is the literal difference between retiring wealthy or barely scraping by in your golden years. So why do millions of Americans sign up for a product that costs 14 times more than it should? It is not because of some shadowy, malicious Wall Street conspiracy. It is simply an incredibly outdated, mathematically flawed tradition that refuses to die because it pays out massive commissions. To understand just how absurd the structure of this product is, think about walking into a dealership to buy a reliable commuter car. You just need something safe to get you from point A to point B to protect your family on the road. But the salesman refuses to let you leave unless you also buy a mandatory high-fee savings account physically attached to the glove box of that car. On top of that, he looks you dead in the eye and tells you that if you ever want to actually access that glove box cash, you have to pay him interest just to borrow your own money. You would laugh right in his face, turn around, and walk out of the dealership. Yet, when a polished financial professional pitches the exact same absurd arrangement, people nod their heads and sign the paperwork every single year. They do this with their life insurance. Now, the agent sitting across the desk from you will confidently tell you that the $400 policy is a brilliant investment. They will pull out an iPad and draw beautiful upward trending charts showing your cash value climbing over 30 years. They will throw around fancy buzzwords like guaranteed returns, dividend paying, and generational asset. They will use the classic renting versus buying analogy. They will claim term insurance is just throwing your money away because it eventually expires, just like renting an apartment, whereas whole life is building equity, just like owning a home. That sounds convincing, right? But here is the mathematical truth. Whole life insurance is not an investment. It is a high-cost wrapper intentionally designed to obscure massive fees. The numbers will unequivocally prove that taking the $372 a month you save with cheap term insurance and simply investing it yourself creates an unstoppable wealth machine that no permanent policy can ever replicate. So why do they relentlessly push the permanent product? Because you have to follow the money. When you sign up for that $400 a month policy, your agent earns a massive commission. That commission is usually equal to 50 to 100% of your entire first year of premiums. That sounds complicated, but simply put, it means your first 12 months of payments go directly into the salesman's pocket to pay for his golf club membership, not into your family's future. It is exactly like hiring a contractor to build a house, and his entire fee is just him walking through the front door. And what about that guaranteed growth they love to talk about? In the early years of the policy, the internal return on your cash is often a pathetic 1 to 3%. After you factor in their hidden administrative fees and basic inflation, you are actually losing real purchasing power. It's like buying generic aspirin at the pharmacy, but paying luxury brand prices just to fund their national television marketing campaign. Let us look at a real-world mathematical simulation to see how this incredibly massive opportunity cost actually plays out over time. Meet Julian. Julian is a 30-year-old freelancer who just had his first child. He's naturally stressed about protecting his family. In Timeline Alpha, Julian gets lured by a very persuasive agent selling whole life insurance as forced savings. He locks into a rigid whole life policy costing $450 a month. Now, because Julian is a freelancer, his income fluctuates. This mandatory fixed expense becomes utterly terrifying during his slow months.
He's literally losing sleep over a financial product that was explicitly sold to him to provide peace of mind. In timeline beta, Julian makes a different choice.
He secures a simple 30-year term policy for just $35 a month. He then channels the exact remaining $415 into a low-cost index fund every single month without fail. He sets it on autopilot and keeps total, uncompromised control over his own capital. Fast forward exactly 5 years. Let us check in on the two timelines. In timeline alpha, Julian has poured $27,000 into his whole life premiums, yet his stated cash value on his statement is a meager $13,000. Where did the other $14,000 go? It vanished into thin air to cover the insurance company's corporate overhead and the salesperson's hefty payday. Now, what if Timeline Alpha Julian hits a really rough financial patch and desperately needs that $13,000 to pay his mortgage? If he tries to pull his money out, he gets slammed by something called a draconian surrender charge. That sounds complicated, but simply put, it means the insurance carrier legally holds your own savings hostage and penalizes you financially for trying to escape their bad product. Meanwhile, in Timeline Beta, Julian spent only $2,100 on his total term coverage over those 5 years, but his automated $415 monthly investments have blossomed to $33,000 in his brokerage account, and he can access every single penny of it tomorrow with 0 penalties. But wait, what about Timeline Alpha and that $13,000 cash value? If Timeline Alpha Julian tragically passes away tomorrow, does his grieving family get the $500,000 death benefit plus the $13,000 in cash value he desperately saved up? No, they absolutely do not. This is the life insurance industry's most glaring omission and their dirtiest little secret. In standard whole life contracts, your cash value does not stack on top of your death benefit. Upon your death, the insurance giant simply absorbs your accumulated savings and pays out the face value alone. They keep your savings. Let that sink in for a second. Crank the simulation forward to year 15. This is the exact moment when the insurance marketing sharply pivots to the infamous be your own bank pitch. They promise you that you can take a tax-free loan against your policy to buy a car or fund a business. But here's the mathematical reality.
You are actually borrowing money from the insurance carrier's general fund, while they lock up your own cash value as collateral. And then they charge you interest on that loan. You are literally paying a premium to borrow the exact money you already sacrificed your lifestyle to build. It is absolute madness masquerading as financial genius. Finally, we reach year 30. Julian is now 60 years old and looking toward retirement. In Timeline Alpha, he has poured an agonizing $162,000 into his whole life contract over 3 decades. His cash value finally hovers near $280,000. It took 30 years of forced, inflexible payments just to get there. Now look at Timeline Beta. In Timeline Beta, the 30-year term policy has officially expired. Julian no longer has life insurance, but here is the massive plot twist. After 3 decades of consistently investing that exact same $415 difference into the stock market, Beta Julian's investment portfolio stands at a colossal $900,000. He does not need a life insurance policy anymore because he has achieved something incredible. He is completely self-insured. By buying term and investing the difference, Timeline Beta Julian stumbled into a massive personal finance cheat code known as Coast Fire. That sounds complicated, but simply put, it means you have built up such a massive investment portfolio early in your life that you never have to actively save another dime for retirement. The compound interest on that $900,000 is doing all the heavy lifting for him. If the market just returns an average historical 8%, Julian's portfolio is growing by $72,000 a year without him lifting a single finger. He is liquid, he is completely free from mandatory monthly premiums, and he is a millionaire. Meanwhile, Timeline Alpha Julian is still trapped paying his monthly premium just to keep his restrictive policy alive. To be totally fair, we have to ask, who actually needs whole life insurance? Is it always a bad idea? No, it is genuinely useful in 2 very specific, highly specialized situations. First, extremely high net worth estate planning. If you are worth $30 million and you need to leave behind a massive, instant pool of liquid cash to cover catastrophic estate taxes so your heirs do not have to liquidate the family business, permanent insurance makes sense. Second, lifelong dependent care. If you have a child with severe special needs who will require round-the-clock medical care long after you pass away, you need a guaranteed death benefit that never, ever expires. If you do not fit into those two exceptionally rare categories, you do not need whole life insurance. Using whole life insurance for the standard middle-class wealth-building strategy is exactly like buying a massive commercial bulldozer just to plant a tiny petunia in your front yard. It is completely overkill, it is wildly expensive, and it is simply the wrong tool for the job. To truly protect your household and build actual generational wealth, you need to ignore the salesman and follow this simple, empowering three-step strategy. Step 1. Get the term policy. Figure out what your family actually needs to survive if your income disappears tomorrow. A good rule of thumb is to secure 10 to 12 times your annual income in coverage. If you make $80,000 a year, get an $800,000 to $1 million policy. Lock in a 20 or 30-year term right now while you are young and healthy to keep those premiums dirt cheap. Step 2. Automate the difference. The famous phrase, buy term and invest the difference, only works if you actually invest the difference. Do not just buy the cheap insurance and then blow the savings on takeout food and expensive car payments. Calculate exactly how much you saved by avoiding whole life, open a brokerage account, and set up an automatic monthly transfer into a broad, low-cost index fund. That sounds complicated, but simply put, it means you are automatically buying a tiny slice of the 500 largest companies in America, so your money naturally grows as the overall economy grows. You have to treat that investment transfer like a mandatory bill that you cannot skip. Step 3. Conduct a periodic review of your life. As your invested assets massively grow over the decades, your absolute need for life insurance naturally shrinks. When your mortgage is fully paid off, the kids have graduated college, and your retirement accounts are overflowing, you will eventually reach a point where you can cancel the life insurance entirely because your actual wealth fully protects your family. The very next time someone sits across from you with a glossy, perfectly bound presentation folder drawing a chart that shows guaranteed cash value growth, you need to stop them and ask them one incredibly simple question. Ask to see the internal rate of return on the cash value over 30 years, perfectly net of all fees, all commissions, and all mortality costs. Tell them you do not want to see the gross rate, you want the real net rate after they get paid their massive commission. If they start stammering, deflecting, or cannot answer you clearly with a printed piece of paper, you already have your exact answer. Keep your insurance and your investments completely 100% separate. Ultimately, life insurance is not supposed to be a lottery ticket. It is not supposed to be a secret rich person banking strategy, and it is certainly not supposed to be the foundational pillar of your retirement plan. It is simply supposed to be a temporary, affordable safety net to protect the people you love the most during your most financially vulnerable years. When you strip away the aggressive marketing, the perfectly tailored suits, and the fancy industry buzzwords, the absolute smartest thing you can do for your family's future is to buy the cheap term coverage, automate the difference into the stock market, and patiently build your own completely liquid wealth. Take control of your own money instead of permanently funding an insurance company's massive corporate treasury. The path to real financial freedom is not bought through a rigid monthly premium, it is built through owning your own assets, understanding the raw math, and never letting a salesman convince you to pay for the privilege of borrowing your own money. Protect your family, invest the rest, and walk away with the $900,000 difference.